Everyone's talking about it, but does it really work? Welcome to Strategy Stack, where we put popular trading strategies to the test. If you're tired of hearing the same strategies repeated by every YouTuber without knowing if they truly work, you're in the right place. Today, we're breaking down the VWAP and EMA strategy for intraday trading. It's praised for its high returns, but does it really deliver? Let's find out. First, let's understand the strategy as described by many YouTubers. Here's the setup for bullish trades on a 5-minute chart. The first 5-minute candle at 9:20 a.m. must be green. The candle's body must cross upwards through the VWAP. The 7-period EMA is below the price movement. Enter a long trade if the high of the first candle breaks on a closing basis. Stop loss is set just below the first candle's low. The target is twice the risk, or you can choose to trail your stop loss. For bearish trades, it's the opposite. The first 5-minute candle at 9:20 a.m. must be red. The candle's body must cross downwards through the VWAP. The 7-period EMA is above the price movement. Enter a short trade if the low of the first candle breaks down on a closing basis. Stop loss is set just above the first candle's high. The target is twice the risk, or you can trail your stop loss. Now, to put this strategy to the test, we headed over to TradingView. For simplicity and effective analysis, we decided to focus on futures contracts. You can choose any instrument that suits your style. First, we selected the TCS chart. To do this in TradingView, simply use the search bar at the top of the screen. Type in TCS, and from the drop-down menu, select the TCS futures contract. Once the chart loads, we move to apply our custom indicator. To do this, click on the Indicators button at the top, then search for the EMA and VWAP strategy specifically designed for intraday trading. After applying the indicator, you'll see the moving averages and VWAP line plotted directly on the chart. Next, we use the strategy tester located below the chart window to assess the profitability. By clicking on it, the backtesting results are displayed, showing key metrics like net profit, win rate, and drawdown. As you can see, the strategy has actually worked, showing profitability during the backtest with the default settings. Next, let's switch to another instrument, for example, Tata Steel. To switch to Tata Steel, return to the search bar, type Tata Steel, and select the appropriate futures contract from the dropdown. The chart will automatically update to display the new data. Interestingly, the strategy is even more profitable with Tata Steel. But what happens if we tweak some of the default settings? After adjusting the moving average to 9 periods instead of 7, the strategy became even more profitable, yielding approximately 77% over a short period. Now, can we call this strategy a holy grail? Not quite. Let's evaluate another instrument to gain more perspective. Next, we selected the SBIN futures contract. To do this, once again use the search bar, type in SBIN, and select the futures contract. Here, you can see that the strategy gave negative returns regardless of the settings. This clearly demonstrates the importance of backtesting across different instruments and market conditions. If you're interested in testing this strategy yourself or deploying it in real time, go to TradingView.com through the link given in description. Search Strategy Stack and follow our profile. Drop a message for link to strategy. If you wish comment for detailed working of the strategy code, we will make this separate video about describing the code and its integration with broker. Don't forget to subscribe to Strategy Stack for more insights like these. Click the link in the description to join our community, where we share live updates and exclusive trading strategies. Remember, these are my personal market observations and not trading advice. Always do your own research and trade responsibly.